What if everything you were taught about money was only half true? Most people believe banks take your deposits and lend them out. That money comes from labor, government, or gold, and that the Federal Reserve simply manages what already exists. Welcome to the Financial Codex. But what if the real story is far more powerful, far more unsettling, and far more invisible? Here's the question that will echo throughout this story. Do banks really store money, or do they create it out of thin air? Imagine walking into a bank on Main Street and depositing $1,000. You assume it sits safely in a vault, but behind the scenes, the bank transforms it, multiplies it, and suddenly there is money in the system that never existed before. Sounds impossible. Yet this invisible process underpins the entire financial system. As we explore how banks create money, hidden patterns and secret mechanisms will emerge, revealing the delicate balance of trust, control, and power. Long before modern finance, money had physical value. Gold and silver were tangible. Lending required actual wealth. In 1694, the Bank of England introduced paper money, representing gold even when the gold wasn't fully there. This subtle shift started a revolution. Banks no longer just stored money. They became creators of it. This early example of fractional banking would later evolve into the complex system we know today, a system that both stabilizes economies and concentrates power. The Panic of 1837 in the United States offers a stark warning. When banks issued more notes than they could cover, ordinary Americans lost everything. Families saw land and savings vanish overnight, demonstrating that the creation of money can have profound real-world consequences. At the heart of modern banking lies fractional reserve banking. If you deposit $1,000, the bank keeps only a fraction, typically 10%, and loans the rest. The borrower spends that money, and it is redeposited, multiplied again and again. What began as $1,000 becomes $9,000 or more in the economy, with no new labor or gold. This multiplication of money is fundamental to banking, yet it remains invisible to everyday account holders. Imagine a single mother trusting her savings, believing it rests untouched, while it is replicated across ledgers she cannot see. The financial system depends on debt to create money, and debt ensures banks' profit. The subtle shift from deposit to loan transforms the economy in ways most people never fully grasp. Throughout the 20th century, banks and financial institutions grew into empires. Wall Street thrived, while Main Street worked to keep up. The 1929 crash revealed the fragility of the system. John, a factory worker in Ohio, lost his life savings when his bank failed. Panic spread as banks closed their doors. The Great Depression left families destitute, showing the human cost of a system built on the illusion of money creation. Similar patterns repeated in the 2008 financial crisis. Families lost homes and jobs while banks were bailed out, revealing the asymmetry of risk in a system where money can be created yet ordinary citizens bear the consequences. The Federal Reserve, created in 1913, was designed to stabilize money supply and prevent panics. Yet it too creates money, digitally, through mechanisms such as quantitative easing. During the 2008 crisis, trillions were injected into the financial system, weakening purchasing power but stabilizing institutions. Retirees and everyday workers saw their savings erode, while banks and corporations remained protected. The process of creating money has evolved from tangible notes to digital entries, allowing the system to expand rapidly, but also creating new vulnerabilities. Money is now born from debt, and every new dollar exists as a promise, an obligation, a leverage point in a vast web of financial interconnection. The human consequences are profound. Emma, a startup founder in Silicon Valley, thrived during periods of cheap money. But when rates rose and liquidity tightened, her business faltered. Borrowing costs changed overnight, demonstrating how monetary policy and bank-created money directly influence opportunity and innovation. Every loan, every deposit, every creation of money is connected to real lives, aspirations, and failures. The system depends on perpetual borrowing, growth without end, and consumption without pause. But when borrowing slows or debt cannot be repaid, the illusion trembles, and financial crises emerge, affecting millions. Today, the creation of money is faster and more complex than ever. Algorithms, interest rate signals, and global liquidity flows mean a single Federal Reserve announcement can influence currencies worldwide within seconds. Inflation, housing prices, wages, and the availability of credit are all intertwined with the creation of money by banks. Hidden in this complexity are patterns and insights. Stability is often code for control, and words like temporary signal longer-term systemic shifts. Awareness of these mechanisms is crucial for anyone seeking financial literacy and security. Despite regulations, bailouts, and stimulus measures, the core mechanism of money creation has never changed. Money is still born from debt, and banks still multiply it through fractional reserves. This ongoing cycle shapes our economy, our daily lives, and our long-term security. Behind the numbers are human stories. Families struggling to survive, retirees watching savings evaporate, and workers trying to understand the invisible forces shaping their reality. Observing these patterns helps identify the hidden rules of the system and empowers individuals to make more informed financial decisions. Looking forward, the next frontier of money creation involves digital currencies, artificial intelligence, and decentralized finance. If banks have always created money, what happens when currency itself becomes programmable? How will AI-driven lending, digital central bank reserves, and global transaction monitoring change the balance of power? The next financial chapter may redefine wealth, ownership, and control. This cliffhanger leads to the next exploration. Who will control money in a cashless, digitized world? 3 actionable takeaways. First, understand that most money today is debt-based, not physical. Second, monitor interest rates and central bank policies. They indicate the direction of money creation. Third, strengthen financial literacy and awareness. Understanding the system is your first defense against its invisible effects. Share your thoughts in the comments, spot hidden patterns, and subscribe to uncover more financial secrets. Because the real question isn't just how banks create money, it's who thrives, who survives, and who is left behind. When the illusion breaks, please like this video, subscribe for more insights, and share your perspectives below. Together, let's continue decoding the world of money.